It is Friday evening, September 12, 2008. High above Manhattan in a dimly lit corner office, a man known as the Gorilla stares out at a city that is about to abandon him. His name is Dick Fuld, CEO of Lehman Brothers. For 158 years, Lehman has survived everything. The Civil War, the Great Depression, 2 World Wars, and the long-term capital management crisis of 1998. But tonight, time has run out. Lehman Brothers is holding $619 billion in debt. To put that into perspective, that is roughly the entire GDP of Switzerland at the time. Balanced precariously on the shoulders of a single investment bank. The stock has collapsed by 94% since January. Fuld picks up the phone. He calls the Secretary of the Treasury, Hank Paulson. He calls other Wall Street CEOs. No one is picking up. The government has decided to draw a line in the sand. Over the next 72 hours, the global financial system will come within inches of total annihilation. This is not just a story of bad math or toxic mortgages. This is a Shakespearean tragedy of hubris, extreme leverage, and the weekend Wall Street died. To understand how a titan falls, we have to look at the foundation. In the early 2000s, Lehman shifted aggressively from a traditional bond trading firm into a real estate hedge fund. They gorged on mortgage-backed securities, or MBS. These were bundles of home loans, many of them subprime. Stamped with a shiny AAA rating by agencies like S&P and Moody's. But here is the fatal flaw: Lehman didn't just buy these assets. They borrowed massive amounts of money to do it. By 2007, Lehman's leverage ratio was a staggering 30-1. Let me explain the math of 30-1. If you have $1 of your own money, you borrow $30 to buy a $31 house. When housing prices go up by just 3%, you double your money. You are a genius. But if that asset drops by a mere 3.3%, your $1 of equity is completely wiped out. You are insolvent. By 2007, U.S. home prices began a historic decline, eventually dropping 20%. Lehman's massive portfolio wasn't just losing value, it was evaporating. So, how did a publicly traded company hide a gaping hole in its balance sheet for so long? The answer is an accounting trick so dark it sounds like a spy movie. Repo 105. A repurchase agreement, or repo, is a standard short-term loan used by banks. But Lehman stretched the rules. At the end of every quarter, they would temporarily transfer about $50 billion of toxic assets off their books in exchange for cash. They used this cash to pay down debt, making their leverage ratio look healthy to the SEC and investors on earnings day. A few days later, they would reverse the trade, buying the toxic garbage back. It was financial window dressing on a multi-billion-dollar scale. But the market is a ruthless lie detector. By early 2008, hedge funds like Greenlight Capital, led by David Einhorn, saw through the numbers. Short sellers began circling. In March 2008, Bear Stearns, another highly leveraged bank, collapsed and was absorbed by J.P. Morgan for a humiliating $2 a share, backed by a $30 billion Federal Reserve guarantee. Fuld watched Bear die and thought, the government saved them. They will save us, too. Back to the weekend. It is Saturday morning, September 13th. Inside the fortress-like Federal Reserve Bank of New York, Treasury Secretary Hank Paulson and New York Fed President Tim Geithner have locked the CEOs of Wall Street's biggest banks in a room. John Thain of Merrill Lynch, Jamie Dimon of J.P. Morgan, Lloyd Blankfein of Goldman Sachs. Paulson's message is blunt: there is no public money for Lehman. You guys need to figure out a way to fund a private rescue, or the contagion will take you all down. The irony is palpable. The very men who helped build the toxic CDO machine are now being asked to pay for its disposal. Fuld is not in the room. He is kept isolated in his own building, receiving sparse updates. He is like a deposed king waiting for a pardon that will never arrive. The only real hope is a buyout. Bank of America takes a look at Lehman's books. Realizes the hole is way bigger than reported, and walks away. In fact, they go buy Merrill Lynch instead. Now, there is only one buyer left. Barclays, the British banking giant. Sunday morning dawns. Barclays is ready to do the deal. They want to buy Lehman. Fuld breathes a sigh of relief. The global financial system is about to dodge a bullet. But there is a catch. Because of British corporate law, Barclays cannot guarantee Lehman's trading obligations immediately without shareholder approval. They need the British government to waive the rule. Enter Alistair Darling, the UK Chancellor of the Exchequer. He looks at the toxic waste on Lehman's books and flatly refuses. He famously tells Paulson, "We are not going to import your cancer." The deal is dead. When the news hits the Fed building in New York, the room goes silent. The realization sets in. Without Barclays, and with the US government absolutely refusing a bailout to avoid moral hazard. The idea that saving reckless banks encourages more recklessness, Lehman is going to fail. Wall Street CEOs scramble to their phones to protect their own firms. The contagion is real. For Fuld, the betrayal is absolute. Why Bear Stearns? Why Fannie Mae and Freddie Mac just a week prior? Why AIG the very next day? Why was Lehman chosen to be the sacrificial lamb? Analysts still debate this. Some say Paulson, a former Goldman Sachs CEO. Let a rival die. But the data shows Lehman was simply too toxic, its collateral too worthless. And the political appetite for bailouts entirely exhausted. The Fed, bound by Section 13(3) of the Federal Reserve Act, could only lend against solid collateral. Lehman didn't have any left. It was all junk. As Sunday evening approaches, the SEC delivers the final blow. They call Lehman's board of directors. The instruction is clear. File for Chapter 11 bankruptcy before the Asian markets open. The gorilla has been caged. The 158-year legacy, built through wars and depressions, is ending not with a bang, but with a frantic typing of legal documents in a sepia-toned boardroom. At 1:45 a.m. on Monday, September 15, 2008. Lehman Brothers officially files for Chapter 11 bankruptcy. It is the largest bankruptcy filing in U.S. history. $619 billion in debt. $639 billion in assets that are practically frozen. When the sun rises, the iconic, tragic image of the crisis is born. Thousands of loyal, mid-level employees, many of whom had their life savings tied up in Lehman stock, walk out of the 745 7th Avenue headquarters holding brown cardboard boxes. The macro impact is instantaneous and brutal. The Dow Jones drops 504 points that day. Within days, global credit markets freeze completely. Banks stop lending to each other because no one knows who is hiding the next toxic hole. To prevent a complete collapse of the global economy, the U.S. government is forced to create the $700 billion TARP bailout. The irony? By letting Lehman fail to prevent moral hazard, the panic was so severe they had to bail out everyone else anyway. The aftermath is a scar on a generation. Between 2007 and 2010, 8.7 million Americans lost their jobs. 10 million homes were foreclosed upon. S&P 500 lost 57% from peak to trough. Dick Fuld walked away with hundreds of millions from past compensations. But his reputation was destroyed, forever remembered as the captain who sank the ship. The story of Lehman Brothers teaches us a chilling truth. In finance, leverage is a miracle until it is a murder weapon. And when a system is built on an illusion, it doesn't matter if you have 158 years of history. It only takes 72 hours for the market to burn it to the ground. What do you think? Did the government make a mistake by letting Lehman fail? Or was it a necessary purge of a corrupted system? Let me know in the comments below. And if you want to understand the intricate mechanics of the financial world, hit subscribe. Until next time, keep your leverage low, and your eyes open. This video is for informational and educational purposes only, not financial advice. All investing carries risk of loss. Do your own research and consult a licensed financial advisor before making decisions.